Welcome everybody. My name's Grace Barnard, and I am going to be your presenter today for Kaizen, the greatest wealth transfer. What we're going to talk about today is a program that NIW has been offering to high net worth clients for the last 24 years. And somewhere along that journey, we decided that we needed to do something for ourselves and our family, and we created Kaizen. And in doing that, we also wanted to make that available to our employees and then obviously our children. And so I'm going to kind of go through the journey of why we created what we created, how we did it, and for the reasons that we did it, and also to invite you to learn along with me some things that I learned from the younger generation that I didn't know when I originally started this program. One of the most interesting things that I found out is that our generation is getting ready to transfer $84 trillion over the next 20 to 30 years. And I think the most interesting thing that I found out in this journey is that this is the first generation that is less wealthy than we were. And it's not because they're entitled, it's not because they don't want to work, it's really about opportunity. And this is the first generation that, even though as many of these kids are graduated, have bachelor's degrees as we had at that time, they do not have the same opportunities. They are 41% less wealthy than we were. And what this really means is they don't have the ability to have the same opportunities that we had. They can't purchase homes like we did. This I thought was another interesting article. 38% of young home buyers today get their money from their family because they can't afford to buy those houses on their own. And Bloomberg is basically saying the way that we used to transfer wealth, we would wait until we passed away, and then whatever was left over we would give to our kids. And that is not the way that this generation is looking at retiring. Some of those reasons are we're living longer, and because we're living longer, we don't have the ability to leave this money to them when they can actually do something with it. So typically, my life expectancy, my kids will be retired by the time I pass away and actually give them that money. So what are they going to do with it? Also, I think that our generation wants to be able to help educate these kids and show them what to do with that money and how to create wealth and help them make good financial decisions. So for myself personally, I wanted to be able to transfer this money to my kids while I was alive, while I had decisions in that, and while I could actually help influence those decisions. So I decided to use some of my gifting exclusions. So every single year, each of us has an amount of money that we can use called a gift, and that gift will change each year depending on what the government regulations are at the time. But this year's gifts are $17,000 per individual parent or $34,000 per couple. And we can use that gift. If you don't use it in an annual basis, you actually lose it. The other thing that some people are doing is they're saying, well, I have a lot of estate money that I can transfer without having to pay any tax on it, and so you might want to use up some of that. For our more wealthy clients, they had already used up a lot of their gifting exclusions or lifetime gifting exclusions, and so they were taking advantage of their additional annual gifts. But however you choose to do that, you could basically set this program up as a gift. You can take distributions from maybe qualified money or an annuity. And why would you want to do that? Annuities and qualified money, when you pass away with those and leave your children as beneficiaries, become taxable to them. And that's not actually how I intended on passing that money down to my kids. I didn't want them to have to take distributions over a 10-year time period and then pay the tax on those distributions. I wanted to pass that on to them more tax efficiently. The other thing I wanted to be able to do for my kids is I didn't want to just give them that money and allow them to go spend it on whatever they wanted to go spend it on. I wanted to provide benefits for them. And first and foremost, the benefits that I wanted to provide to my own kids, just because of my own personal family situation, is I wanted to be able to provide protection. So in my own personal family, there's a lot of health issues. I have a sister who has MS and ended up going into a nursing home at 45. And so it was important to me to be able to provide some chronic illness protection to my children. And there's a policy out there called an Index Universal Life Policy, and there's carriers out there that will allow you to take that death benefit and use that as a living benefit so that it can actually provide cash in the event that they need it for a chronic illness or maybe a critical illness, death, or they can use it also as income. And here's a quick introduction into how I'm using that as a gift to my children and the benefits of that gift from the Greatest Wealth Transfer, from the policy, and from the design.
After meeting with your financial advisor, you're happy to learn that all your hard work and sacrifice have put you in a place of wealth, allowing you to live the retirement of your dreams with those you love the most. The only thing left to think about is, what will I pass down to my children or grandchildren? Wealth transfers done through annual gift tax exemptions or lifetime gifting exclusions often raise a question. What will our kids do with all our hard-earned money? Much like winning the lottery, access to inheritance all at once can be spent in the blink of an eye. In the US, 80% of people have trouble keeping their spending within their budget's parameters. Would you rather give your kids $250,000 in cash now, or give them the potential for 5 to 10 times that in their retirement? Introducing the Greatest Wealth Transfer, brought to you by Kai-Zen. Kaizen is a way to provide annual gifts to your children to fund a uniquely designed life insurance policy. Why life insurance? Because life insurance can provide your loved ones with death benefit protection that passes tax-free to their beneficiaries. Life insurance also provides the potential to earn interest. Any potential gains are locked in annually, and compounding tax-deferred. Because your money is not directly invested in the market, it cannot suffer losses due to market declines, making it one of the safest products to combine with leverage. Why use leverage? Because Kaizen can enhance your policy benefits and potential distributions by an average of 60 to 100%, which can be taken tax-free when using policy loans. Using leverage means you don't have to fund for years like most policies. With Kaizen, there are only 5 annual contributions, of which a small portion is used to fund death benefit and living benefits. The remainder of your contributions are combined with leverage, enhancing your potential for growth. In approximately the 15th year, the loan is paid off with the policy cash value. This means your heirs won't have to wait until retirement age to access the policy. They may use it to fund a first-time home, college education for a grandchild, or help supplement their retirement. Kaizen uses unique life insurance for a reason: safety. Just like a butterfly, your wealth undergoes remarkable transformations. Think of your current wealth as a caterpillar stage, steadily accumulating over the years. By implementing a sophisticated strategy, you create the protective shell that fosters growth, similar to the caterpillar's transformation into its cocoon. With our strategy, your wealth isn't static. It has the potential to expand, much like the caterpillar turning into a butterfly. As you pass on this augmented wealth to your children, you create a financial legacy that shapes their future. Take comfort in knowing your gift can provide your loved ones benefits for a lifetime. Don't leave your legacy to chance. Leave it to the Greatest Wealth Transfer by Kaizen.
So just as a recap, let me explain on a high level how this product works, and then I think that you can go to the agent that invited you here and get a lot more details. But what it originally does is it allows you to make very short contribution periods. So you can use 5 annual gifts, or you can make 5 contributions to this plan for them. We take those 5 contributions and we add them to a uniquely designed life insurance product. Now, why life insurance when we're talking about very young kids? They don't typically need life insurance. But as I said a minute ago, that life insurance doesn't just provide death benefit, it also provides living benefits. And those living benefits will allow the kids to access chronic illness, terminal illness, or in some cases, critical illness, meaning that instead of using the death benefit after they're gone, they can take that death benefit, accelerate it up front, and get cash in the event that they need it while they're alive. You could think of something like MS in my sister's example, or you can think of something like children that have gotten cancer and maybe the drug treatment is experimental, or maybe mom and dad need to quit working and provide in-home care. Any of the things that you might think of that you would need that access to that money, they can pull that cash out in the event of those critical or chronic illnesses. However, most of us know that these are young kids. In my example, my child was 22 when I did the first design, and so more than likely they're not going to need it for the chronic or the death benefit, but they're going to need it for the growth potential. And the way that this policy works is once these small amounts taken out for expenses, the rest of that money is excess going into a fixed account that earns interest. And the way that this fixed account is designed is it will allow you to get access to growth on an index such as the S&P or the Dow or the Euro or something like that, and it will allow you to track that market upside growth. So the first thing that it does is it waits at the beginning of the year whenever you participate in it, and it watches what the market does, and at the end of the year, wherever the market ends up, then if it's up, you get to capture that growth up to a certain amount, lock that into your policy. But what's more important about this design is its ability to eliminate the losses. So if in an example of an annual year or any given year that the market goes down, the way the policy is designed is you will not suffer any of those market losses in a downturn. That's the most important part of this plan in the way that we've designed it. And why is that important? Because this design is adding leverage. The way this plan was designed is it will allow you to add up to 3 times more money using lenders' contributions. That means that immediately we can get more death benefit protection, more living benefit protection, but it also has the potential to enhance the growth that we're getting on the policy. And considering a lot of these kids are in their 20s and 30s, they have many more years to compound. They have a lot more money that they can get that compounding and that growth on that policy. And so the contributions can be significantly higher with that additional contribution from the leverage. When I said that the most important part of this was the zero floor or the elimination of that risk in the market, that is because if we're going to be borrowing money and adding that to 3 additional times or that 3 times more money using leverage, we don't want to take the liability on losing the bank's money. And so the way that this policy was designed is the principal is protected. So any of the money that you're borrowing from the bank is principally protected. And it's the interest on that growth of that account that allows us to get money or get gains or try to capture some of the upside of the market. But this is what makes this design very, very unique. Unlike any other time that you use leverage, when you combine it with a home, when you combine it with a car, or when you combine it with real estate, you have to go do financial underwriting. You typically have to sign loan documents. In my example, the last time I refinanced my house, I was in the mortgage office for about 4 hours signing paperwork. You have to commit to personal guarantees in the event that the house goes down in price, and you have to make out-of-pocket interest payments. But the way we've designed Kaizen is you don't have to do any of that. You're not on the loan, you're not party to the loan, so you don't go through any financial underwriting, you don't sign any loan docs, you don't do any personal guarantees, and there are no out-of-pocket interest payments or principal payments. So the only amount that you're contributing to this plan is your 5 contributions, and you're done. That allows us to be able to get access to leverage in a very different and unique way. So as you're putting in your 5 contributions, the bank is also matching those 5 contributions. At the end of that 5-year time period, we're done, and the bank is going to continue to contribute both contributions, yours and the additional 5 years that they did, and that means that you're going to get a basically 3-to-1 contribution match on the money that you're contributing. Once we set that money into these policies, those policies are assigned to the lender, and there's a third-party trustee that manages those policies. Once the kids are ready to get out or use the benefits, they simply take the money out of the policy, pay back the lender, and now they can use or access those benefits in any way they want at any time they want. So if that was the end of the first year and they had some type of chronic illness or critical illness, they can go access the benefits of the policy immediately. However, this allows them to have time to grow this money and use that additional money. And in that growth, we can significantly enhance what they're going to have to save for their own retirement. And it doesn't necessarily have to be strictly for retirement. They could use that money for the first-time home buyers. So if you think about the comment I made earlier in the presentation about how many of these kids are having to borrow money from their parents to buy their first-time house, we could gift them a policy like this when they're young, and when they get ready to buy that house, they can access the policy and use that as their down payment. Or if they're young and they haven't had enough time for this to grow and we funded it for them, this may be a way for them to pay us back at a later date once the funds have started to grow and establish. Another way we could use this is we might start these when we first have babies or our kids first have babies, and then we can help them educate their grandchildren by taking the money out of these policies, funding their college for a few years, and then allowing it to grow and accumulate again for their retirement at some later time down the road. So you can do multiple designs. You can maybe do one in a 5-year period of time that you want to use for first-time buyer on a house. You might do another one in years 6 through 10, where you're going to do one for college education for your grandkids, and then you might do another one for critical or chronic illness, and you might help them with another one for their own personal retirement. There's really no end to the ability of the things that they can do with this, and I think the biggest thing from my perspective is providing them choices. I just wanted them to have access to some choices, and I didn't want them to just take that cash and go spend it on a European vacation, which is fine, by the way. Just let them do that with their money. What I wanted them to do with my money was this. So in my conversations with so many other boomers, my generation, people that I've talked to, they really wanted to help their kids. When they've secured their own financial future, they really wanted to turn their attention to how they could help their kids. And I was kind of shocked at the number of people that wanted to participate in this platform, hence the reason why we created Kaizen as the greatest wealth transfer. So let's listen to some other people that are in the same or similar situation that I am.
It's been my observation that our kids didn't have the same economic opportunities that we did. I'm just absolutely positive that tax brackets are going up, probably during my lifetime, but certainly during my kids' lifetime, as they pay for old people like me for Social Security and Medicare and things like that. But then the trillions of dollars of national debt, including the trillions that were just added on in the COVID crisis, it's going to have to be paid back, and the kids are going to do it. Tax brackets are going to go up. I was looking for ways to be of help to them. I've reached a point in my life where I think my wife and I have enough that we're going to be okay for the rest of our lives.
It wasn't until I was pregnant that we then realized that there was the potential of a lot to lose.
That's where I think this Kaizen program fits in really well, because I can gift them to something that is for their future, but something that is I have a little bit of control over. I know where it's going to go.
So that's when we really looked into it and made sure that we had a plan. So should anything happen to us, she would always be cared for.
But I said to her, as we made the second payment this year, and I talked to her about it, and she said, "Dad, you have no idea how important this is to me."
It's a really big gift from him, and also to know that we can be taken care of as we get older.
For all of you that are in a situation where you would like to pass on some of your wealth to them now while you're alive, and you have the opportunity to help educate them, guide them, give them decisions, help provide for your grandchildren, whatever those reasons are. If that's you and you want to contribute and you'd like to learn more about this program and the benefits that it can provide to your children, please go back to the agent that invited you to the webinar and allow them to invite you into ILIA, where you can do your own designs, look at what it can provide for your own children, and you can educate yourself and ask questions of your advisor. So if you have any questions, please leave them in the comment sections below and we will respond. Or if you prefer, please get with the agent that invited you today. We hope you're as excited about the greatest wealth transfer as we are, and thank you for joining today.